Hi, welcome back to Investor Insights. In this video, I'd like to discuss fundamental and technical analysis and the part that they play when investors and traders decide to get into a position. First and foremost, fundamental analysis is basically looking at the fundamentals of a company and its business environment. So you can have either a top-down approach, which is looking at the macroeconomic situation. So you look at things like GDP, you look at interest rates, you look at inflation, you look at the business cycle, you look at consumer confidence, everything that affects the national's output and the growth prospects of the company. And then you've got the bottoms-up approach, which you would look at the specifics of the company and its growth prospects itself. So you'll be looking at things like balance sheets, you look at debts on the balance sheet, its customer base, and where its profit's going to grow, if it's likely to be either growing through vertical integration or horizontal integration. It's all analysis that the investor is going to look at before he or she decides to buy a stock or short a stock for that matter. Technical analysis or quantitative analysis is more looking at the actual price action over the recent or long-term history of a stock or any other instrument for that matter. It doesn't matter if it's currency or bonds, whatever that you decide to invest or trade in. Quantitative analysis is more used by traders because when people trade, fundamentals sometimes don't make sense, or I should say the stock price or the currency levels don't make sense when linked up with the actual fundamental analysis, because a whole bunch of lemmings are controlling the actual markets that you're trying to trade or are distorting the markets, and sometimes those distortions can last for months or even years. Look at the Fed's quantitative easing program. Now that's distorted bond yields and inflated a huge bond market bubble for the past 4 or 5 years. And that in turn has driven a lot of money into the stock market, and that's inflating another bubble. So when you're trading and you use technical analysis, you can see that the market's going higher. But the fundamentals aren't there to support those stock prices. And therein lies the choice to either trade or invest. So if you don't believe that the fundamental supports the price of a stock, then you're obviously not going to buy it. And in fact, you should be shorting it. One important thing that you have to remember is shorting a rising market is just like trying to catch a falling knife in a collapsing market. You can get crushed. So you have to work out your entry points, and you use that using your technical analysis. Don't be afraid to hold your ground. Don't be afraid to get into a position if you believe that the technicals are working for you, despite the fundamentals not being there. So I myself will not go long this market, despite telling you that the market is going higher. The fundamentals just aren't there. And I practice what I preach. I will not put money into something that I truly don't believe in. I could be as wrong or as right as the next guy. It doesn't matter. I form my thesis, I stick by it, and there's nothing out there which has proven me the opposite of what I'm thinking at this point in time. So therefore, I'd like to short recent highs, keep a tight stop on the upside, and basically pocket profits when the market retreats. Fundamental analysis, to me, plays a more important part in most of my trading and investing decisions. As I said before, technicals may be running the game right now, but fundamentals always catch up. Markets always find a way to make things right. By right, I don't mean that I've got a grudge or I'm a doomsday prophet. I just mean if a company doesn't generate enough profit to justify its price, so looking at things like your price earnings ratios, once they start to rocket up, then the likelihood of you being burnt going long is getting higher and higher. And the likelihood of you succeeding by shorting the stock is getting higher and higher. So know what you're doing by understanding the fundamentals. Use technical analysis more as a backup to decide if it's worthwhile getting into a trade or trying to work out the entry point for a trade, but don't lose sight of the bigger picture. The market always misprices stocks, and fundamental analysis gives you the insight into working out what companies have been beaten down by the market and are now undervalued. So they will give you the best prospects for capital gains and possible dividend gains by investing in these undervalued companies when the market reprices them accordingly to what their earnings or their future earnings are. And if the market misprices stocks on the upside, for example, my favorite is always going to be Netflix. You can't invest in companies that have such high PEs in a low growth environment, and companies that have such deflationary assets or assets that aren't basically real. They generate their income from technology, which is highly deflationary anyway. I would not be touching it. I can tell you 99 times out of 100, if you were to buy into a company that had a P ratio of above 30, 35, 40, you're going to lose money. There'll be the odd one out there that's going to be taken over at a huge premium, or it could be discovering a biotech company might discover a cure for some disease somewhere, and the stock could jump 20-fold. You know what? They do happen. But the fundamentals normally tell you that a stock is either undervalued or overvalued, and you should use that as a guide to finding those opportunities to go long or short within the stock market. And the technical analysis would provide you basically with the entry points. And exit points, obviously. So keep that in mind the next time you're about to execute a trade.